I would like to clarify a few things about the GM Plant X. As we discussed last week, I showed you a few of the calculations, but I would like to briefly go over a few things that could help you just to complete the spreadsheet. So right now, we are on the revenue sheet, where we calculate the revenues from each of the respective markets. For instance, here we have Blue Macau's sales in units in Brazil, and then we do have the retail price in Brazil, which is going to be adjusted based on the exchange rate and the prices. So we do have some data about these. I mean, these are coming from a sort of an assumption sheet in here that I will show you where these data is coming from. So, for instance, 207,360 is coming from the progression of the car market in Brazil, which grows at a 20% rate up until 2000, and then growth rate drops to 10%. And then we also use the Blue Macau's market share, which is 8%. Then it is going to go up to 12, 15, and 18%, and so on, which are given actually in the case. And based on this data, we are calculating the Blue Macau's sales units. We do the same thing for Argentina and Chile. Again, the respective total markets growth rate and the prospective market shares gives us the volume data, which is then used in the revenue sheet. The prices come from, again, from the same spreadsheet where we have in here the prices, sales prices are listed in Brazil in here in reais terms. Macau's pricing will change based on inflation minus an adjustment for the durables. The inflation, for instance, expectation for 2000 is 30.40%, but Macau is going to increase its price by 6% lower rate than the inflation rate. In this case, it is going to be 7.40%. So 10,000 reais price is going to go up to 10,740, and so on. The same set of arguments are used for Argentina and Chile. There we have the pass-through effect that we need to capture, and which are indeed captured in this sheet. So the Argentinian price, for instance, is calculated based on the Brazilian price in reais, which is then converted into Argentinian pesos based on the prevailing exchange rate. And then in the following years, we make certain adjustments depending on what pass-through rate we are assuming. I showed these calculations in the class on Tuesday, so I'm not going to repeat those. But essentially, the revenue data is just generated by using these sets of assumptions. So we need volume, we need price for each respective market, and that would give us the total revenues. I am going to go fast forward to the balance sheet and income statement. I'm going to discuss both of those. Income statement is quite complicated, but it is going to be, again, using calculated using the sales revenues in respective markets that is sort of developed in the revenue sheet. We have Brazilian markets sales revenue that is coming from the revenue sheet as you see in here. Similarly, Argentinian and Chilean revenues are aggregated to 2,431,000. The net sales are calculated in here. We have the total unit sales and aggregation of the Argentinian, Brazilian, and Chilean units. And then we calculate the labor costs, the power utilities, local materials, and so on. So if you look at the labor cost, for instance, that is going to be based on units sold, total units sold, and the assumptions that we made about, or the calculations that we made about the cost. So I'm going, as you've seen here, we are referencing the cost sheet, which is right in here. I'm going to click on this and see what we see in the cost sheet on D20. So the cost sheet shows us the per unit labor, power utilities, local materials, and the cost of imported sub-assemblies. So we have the total manufacturing cost in here. These are all reflected in right in here. We incorporate the labor, power utilities, local materials, and so on. And the total cost of manufacturing, labor cost of local cost of manufacturing is captured in here. And then we add up the imported assemblies or parts, which gives us the cost of manufacturing. And then we incorporate the depreciation expenses. Again, depreciation expenses actually will depend on the total capital invested. We have depreciable assets like plant and equipment, and the depreciation that is allocated for those are represented in here. For instance, we have $85 million of plant and $50 million. Let me just go and just show those in here. We have depreciable assets of plant and facilities, paint shop facilities, and equipment. And all of those are captured in here. The depreciation schedules are given for each of these assets. For instance, the depreciation pace of plant, paint shop, and equipment are not the same. Therefore, you have the respective weights in here, depending on the depreciation schedule of all of those, which are given in the assumptions in the case. So we use those assumptions to calculate the depreciation expenses. We add up general administrative expenses, which come from our assumptions sheet. So here we have on D13, we have gross sales revenue, and the general administrative expenses are a percentage of the gross sales revenue, which is given here in the assumptions. So if you look at the cell in here that includes the general administrative expenses, we have D13, which is the cost of goods sold. And then in the assumptions sheet, we have the percentage on B43. So if you go back to the B43 in here, the general administrative expenses are 6% of the cost of sales. And that should be showing up in here. I think D13 is the... well, I'm sorry, this is the cost of sales, total cost of 6% of the sales. So sales are on the 13 is 2,431, and then we take 6% of that as general administrative expenses right in here. We have the licensing fee to the parent that is again given information. We pull that in here, pull up all the expenses aggregated. We have gross operating expenses. And then we need another item in here, which is the interest expenses. So We already also worked on this earlier when we calculated the debt amortization for reais and US dollar loans. We know how much in reais terms what our loan interest expenses, both for US dollar and the reais, the Brazilian loan. We have the interest expenses in real terms, and then we include the FX gains and losses, which gives us the total financial expense. And then we subtract the financial expense from our gross operating income to get to the earnings before taxes. And then we subtract the income taxes to get to the net income. So in this fashion, you will complete the income statement. Again, just to repeat, we have the sales revenues that are generated in respective markets. They are aggregated in here. We have the total net sales or gross revenue of the sales. Actually, gross and net are equal in here because we don't have bad debt expenses in here. So we also have the aggregated volume in this cell. So we calculate the labor cost, power utilities, and local materials. These are all coming from the cost sheet in here. We have the unit cost, and we do have the total units in here. We can calculate these costs without any difficulty, and the total manufacturing cost in here is given 1,179 Brazilian reais. And then we have the imported assemblies that, as we mentioned in here, we just included in there. Finally, we have the cost of manufacturing and other expenses, depreciation, general and administrative expenses, and licensing fees all are entered in here. Distributed overhead is also a assumption that is entered into the assumption sheet based on the sales volume, and that gives us the operating expenses, and then we get the gross operating income in here. And again, by going back to the debt amortization, we can pull out the interest expenses from those. Include the FX gains and losses, and we get the total financial expenses. This brings us to the earnings before taxes, and then apply the tax rate again from the assumption sheet. We get net income, and then we can divide this into retained and distributed. So a good chunk of the income is going to be retained for reinvestment, and then there's a distribution in here. Again, this based on the data that we have, D46 is the distribution, which is the percentage of the income that is going to be distributed. It is given in the assumption sheet B9. If you go back to the assumption sheet and check it, B9, dividend payout is only 20%, so 20% is calculated, the rest is retained. So 80% is retained, 20% distributed, and we know what goes into the parent and what is retained within the firm. So this shows up how we can put together the income sheet or income statement. Then the balance sheet is one thing that we want to discuss or talk about the details in here. Some of these are coming from the assumptions that we had. If I may go to the assumptions sheet in here, we have a bunch of assumptions that we made about cash, inventory, for 1997 and 1998. These are the information that is given in the case. So we have $30 million of cash, $35 million of beginning inventory, plant and facilities investment is $60 million, paint shop facilities $30 million, and equipment is $70 million. The total investment in 1997 on land was 20 million, plant facilities 25, but we made another 60 million investment in 1998 to complete the plant facilities. The total assets, fixed assets, are going to go up to 85 million. Paint shop facilities, again, 20 million plus 30 million is going to be 50 million, and then we have $70 million of equipment. So all of those are incorporated into the balance sheet in here. So as of 1998, we have 35 million inventory, 30 million in cash, so $65 million in current assets. And then we have land, plant and facilities, paint shop and equipment altogether listed in here. And this gives us a net asset base of 225 million US dollars. And then on the liability side, so the total assets, including the fixed assets plus $65 million of current assets, we have $290 million of total assets in place in here. And the financing of this was, if you remember, $120 million of that was long-term debt of various kinds. We got 40 million reais of government debt, $22 million from a bank. GM long-term debt is 18 million, and then there was a bond issue for 40 million reais equivalent, and the total long-term debt is about 120 million reais. And then we have $170 million of equity. So the total equity is 170 plus $120 million of debt, liabilities, and equity is equal to 290 million. So the complications start with 1999 as the operations start. So the cash position, as you see in here, is negative. So the accounts, I'm going to show you where does this come from. So this is actually from the cash flow statement in the next sheet. I'll show you the details of that. But accounts payables or accounts receivables are based on the average collection period of 180 days. So we do have 2,431 million reais annual sales. If we calculate the daily sales, we need to divide this into 360, assuming a 360-day year. And then we will multiply this 180 to find out the accounts receivable. So this is the typical the accounts receivable calculation based on average collection period. So simply daily sales times average collection period gives you the accounts receivables. That's what we have in here. And then similarly, we do the math for the inventory. We do have, in this case, a day sales inventory data. Let's see where this information is coming up. So we have cost of goods sold, which is calculated in the income statement, where we develop right in here. So 1,946,000. So if you go back in here, cost of goods sold is in the D26 in the income statement. D26 right in here. So we have the cost of manufacturing. And then we use the assumption in cell B50. If you go back to the assumptions and check what is in B50, in B50 we have inventory as a percentage of current year manufacturing cost, which is 8% of the manufacturing cost. So here we take 8% of the cost of goods sold, which is 155,688,008. So that this gives us current assets. And then we have land, plant, facilities, equipment. Now we need to make adjustments in here based on depreciation. So for instance, cumulative depreciation on plant is 30,100,000, which is coming from the capital sheet. So in the capital sheet, actually, we do have the amortizations or the depreciation schedules in here. The depreciation schedules for plant is 6%. So we calculate this as, because this is plant is going to be depreciated over a 25-year period, but there is a 50% increase that just gives us an 6% depreciation per year. The paint shop is depreciated again over a 3-year period, again with a 50% increase. It just amounts to 50% depreciation allocation per year. The equipment is depreciated over a 10-year period, but with a 50% increase, that increases 15% per year. So these are calculated based on the case assumptions. And this is the depreciation schedule for plant, paint shop facilities, and equipment. And that is incorporated into here. So the net fixed assets are calculated based on these depreciation schedules. And that finally gives us the total assets. So again, here our task is to calculate the accounts receivables, inventories based on cost of goods sold. This is based on total revenues. And then we do have the fixed assets, but starting from 1999, we start to depreciation allocations, and depreciation reduces the fixed assets on the books. So that gives us net fixed assets in here, which finally get the total assets. Now, how do we get the cash position? So this is important. So in order to do that, we need to go to the cash flow statement. So in order to develop the cash flow statement, we start with the net income. We add back depreciation allocations. Again, it is coming from the balance sheet or our earlier capital calculations. So this is exactly the depreciation allocation that we have in the balance sheet in here. So 30,100 plus 10,500, so 40,600,000. It is right in here. And then we do have, so these are net income plus depreciation. Now, any change in the accounts receivable, any addition into the accounts receivable will have to be subtracted in here. So we had initially 0 accounts receivables, and we suddenly have 1,215,880,000 reais accounts receivable. So that means an increase in accounts receivables of this amount, which reduces the cash available. So we're going to record this as a negative. And then additions to inventory is 120,688,000. Now, if we go back to the balance sheet, initially we had 35 million raise of inventory to start with, but cost of goods sold times 8% gives us 155. So the increase is 155,035 million, which is just captured in 120,688,088. So this is additions to inventory. And then we are going to add additions to accounts payables, because accounts payables actually is the credit extended to the company, so it increases the available cash. This is going to come from, again, from the balance sheet. And based on, we calculate these, again, based on the assumptions that we were given. Let's check this in the balance sheet first. So let's see, figure out the amount of accounts payables. So accounts payables calculation in here is, again, we purchase goods, but it takes us 180 days to pay. So we calculate the daily manufacturing cost and multiply that with 180 to calculate the accounts payables that we have in the local market. So we purchase local inputs, but we only pay 180 days later. This means that we have actually locally 589 million reais of credit allocated to the company. This increases the available cash. And then parent company has, again, provides or extends credit to the Macau, because we purchase, we import inputs, assemblies from the parent company, but we pay them 180 days later. So that also increases available cash that we have, that we calculate in here. And then we incorporate those actually right in here. Eventually, we have net cash flows from operations of 207,937,953. We don't have any investment activities this year, so there is no cash allocation to the investment. But we have to pay back principal on the debt that we have received from the government, the bank, the General Motors, and the euro dollar loan that we had also is going to be amortized. So we are going to make principal payments on it. And also we do have dividends that are paid to the parent company, which is 20,995,917. So we also incorporate the FX losses in here. Altogether, we have net cash flow from financing of 36,973. Now, we are going to aggregate the cash flows from the operations and financing and investment in here. So we started the year with $30 million of cash. But the combination of net cash flows from financing, which is actually an outflow, 36 million outflow in here, a net outflow of 207 million in here. So altogether, we have 244,911,000 cash outflow, which brings us to a negative cash of 214,911,739. So this goes into the balance sheet as a negative cash figure. So this is the negative cash that we have in here. And that sort of balances the balance sheet. Altogether, we have balance sheet balance. And then going forward, we repeat these calculations. As you see in here, negative cash balance continues because actually company is not really getting positive cash in the process. So that helps us to create the balance sheet. So we have the cash position in here. As you see, throughout the project, the cash position is negative. The weighted average cost of capital calculations can be done by using the debt and the equity calculation. So I do have, as you see in here, we use the local CAPM model plus the weighted average cost of debt. Altogether, the Brazilian reais cost is about 22.4%. And then we move on to the project assessment. So we do have the total income of the Macau. So Macau's earnings before taxes calculated. And then we incorporate that into the project viewpoint. These are our investments: 65 million in 1997, 225 million in 1998, a total of 290 million reais investment. The operating cash flows, 195 million, that is coming from the income statement that we developed in here. So EBIT, earnings before taxes. Actually, this is the earnings before taxes. We add back the depreciated the financial expenses in here. So let's take a look at it in here. EBIT, which is the earnings before taxes plus financial expenses, or we could simply take the operating expenses before financial expenses. So 195, 803, 499, which is earnings before interest and taxes, is right in here. And then we subtract the actual taxes that is paid. We have net operating income in here. We add back depreciation. The net working capital change is 360, 63,517. This is again coming from the cash flow statement. Cash flow statement is in here. Our total increase in working capital is right in here. We have additions to AR, accounts receivables, additions to inventory, plus the accounts payables to the local market and accounts payables through parent company. So when we aggregate all of those, we have 363, 517 negative. This means that available cash drops by this amount. And net operating cash flow for the project is negative in here. So as you see, that negative operating cash flows are continuing as we go forward. So project is actually net negative cash flow project. And obviously, when we look at net present value, we get a negative value in here. So in order to look at the project from the GM perspective, we need to look at the remittances that are received by GM. So in order to calculate that, we look at the distributed dividends. If you remember, 20% of the income that the company is generating is going to be distributed. We have Brazilian withholding taxes. We need to account for those. Net dividend remitted is 12,590,570 in US dollars. And then we have the withholding taxes in here and the payout rate times the corporate tax income in here. The total grossed up dividend that is based on the remitted dividends is 29,169. So if you remember, we are receiving this, which is only 20% of the income, but we are also paying taxes in Brazil. We add back those paid taxes to come up with the grossed up dividend. And based on US taxes, we do have to pay for this income 10,209,352 taxes, but we already paid 16,579, so we get actually a tax credit of 6,369 in this case. Net dividend then remitted is 12,590. So there is no U.S. tax liability in this particular case in here. and even we have a 6.3 million foreign tax credit that we can actually use to reduce our general tax liability. We go through the calculations, and the net taxes, net remittance that we receive, again in US dollar terms, 8,233,000. Since the taxes that we pay in Brazil, both withholding taxes and the corporate taxes, exceeds the US tax liability, we do not pay any additional taxes. So everything that is remitted that actually is received by the company. But since 2002 and 2003, if you look at the income statement, are loss years. Since we are generating losses in here, there are no remittances that are made to the parent company. So remittances are zero for those 2 years. So we don't get anything in the 2002 and 2003 as remitted income, but we still do have license fees that are transferred. But we do pay withholding taxes for these. The net licenses that are remitted are in this line. Now, for the license fee that we receive, the net amount that we receive is, in US dollar terms, is $43,936,000. We add back the withholding taxes to this amount and get the grossed up license fee. And now we are going to be subjected to taxation for this amount. The theoretical tax rate is $17,086,000. But since we have paid $4,881,000 withholding taxes, we are going to get credit for that. And the additional taxes that we have to pay is $12,204,000. So the net dividend that we receive, net license fees that we receive is $43 million. We have to pay $12 million taxes on it. The net amount after taxes is $31,731,000. In addition to this, we also receive interest on the debt that we provided to the company, plus the principal that we receive. So those are accounted for in here. So we do have $3.2 million of interest that we receive. That was withholding taxes. Net interest that we received is $2,754,000. These are in reais, and we convert these into US dollars, which is 2,010,437, and then 354,783 is the withholding taxes. We add this back. Grossed up interest that we receive is 2,365,220. The tax liability for this is 827, but for the withholding taxes, we get tax credit, and additional taxes that we need to pay on this is $473,000. The net, the dividends that we receive is $1,537,000. So $2,010,437 minus the tax liability that we have in here is equal to net amount of $1,537,000. And then on top of that, we receive the principal payment, and total principal and interest received is this. And the overhead that was charged for the subsidiary is also a inflow for the parent company. So we account for that as also an income. This is in reais terms, but since that is transferred as a payment to the company, there is a withholding tax for that. Net amount that is remitted is $32,828,000. And then net overhead that we receive is in US dollar terms $23,965,000. We add back depreciation, I'm sorry, the withholding taxes that we paid to Brazil. Grossed up amount that we received is 26,627,000. The tax due because of this revenue is 9,319,000. But because of the withholding taxes, we get some credit, additional taxes that we have to pay, 6,656,000. So the total received is 17,308,000 for overhead. So now we are going to aggregate these for the GM. So the earnings on transfers after tax is 55,333,000. Dividends, the licensing fees, interest after tax, distributed overhead, and all of those aggregated in here, we have net cash flow of 112,801,000 and so on. So if you do the calculations in here, we get the net cash flows for the parent company. The total amount of capital that was committed or put on risk in this case, first year 60,747,000, and then we have 87,133,000, and also there is a debt component in here. So the aggregated total capital at risk is 60 million first year and 102 million in the second year. And then based on this, when we calculate the net present value, actually we get a positive net present value. So when we look at the project actually from the parent perspective, it looks profitable, but the Macau as a standalone entity is not really profitable. So I think I gave you enough clues in here that I hope that you can maybe complete some of the missing elements. I just want to point out that there's a dramatic difference between the value of the project from the GM perspective versus the value of the project as a standalone component. So I'll stop in here, and I hope this was useful. If you have any specific questions, you can ask me, and I'll be happy to help you to answer those. So I'm going to stop the recording in here. And again, I hope that this was helpful.